because we had a lack of productivity, a lack of supply, and a tremendous amount of money available to people to buy. The demand was a little higher, but supply was really restricted. Productivity was really restricted. So now what we have is a normal economy, an economy that's normalizing, getting back into that range. I mean, can I just say I'm having a great hair day? I'm having a great hair day. I'm just looking like, wow, I'm having a good hair. I haven't had a good hair day in a couple of weeks now. This is solid. I'm having a great hair day. And it's a Friday. It's perfect. It's a perfect number. It's about as good as it gets. Not too hot. It's not too cold. It's Goldilocks.
Welcome back to the Intelligent Investment Show. I'm Garrett Lill here with the Las Vegas legend, Matt Dahl of ARPG. Living legend here out there. How's the 150-degree weather in Vegas? Is that about where your average is now this time of year?
Pretty much. Yeah, it's great. Our gas bill is way down because we don't have to use, we don't have to use to cook anymore. We can just go outside with our food and it cooks by itself. Great.
Yeah, 5 minutes on the sidewalk and you have a medium well steak. Yeah.
Yeah, you just take your eggs, your steak, your chicken, walk around the block, just leave it on your plate, come back, it's perfect. Yeah.
I imagine, so when you race cars in Vegas this time of year, like, do you need fuel or you just like go to light a cigarette lighter next to the engine and it just takes off?
Right. Well, the funny thing is it's so bad here that they shut the track down basically 1st of June, middle of June. They don't open it back up till middle end of August. Just shut down.
Yeah.
It's too hot. They used to run them at night, but it doesn't work. There's too many lights. It just doesn't work. So they just don't run they basically take almost 3 months off.
Man.
Yeah.
Crazy stuff, man. Well, so we were, last week we talked a little bit about
earnings season. Earnings season was getting ready to kick off. And I know you mentioned the number yesterday, like 157 companies had reported or something like that. Some very specific big number is what you gave me yesterday that have reported so far.
Yeah, we have basically 80% of companies beating by about 5%. 199 companies, so 200 of the companies have reported. So 40% of the S&P 500 has reported. 69% are beating by a median of 6%. Okay. Of the 20% that are missing, they're missing by about 4%. On the top line, the revenue line, looks like we're beating estimates by a median of 3%. So, and
how is that broken down? So when you say 80% of the S&P is reported and beat by that number, how much is that, if you broke it down in terms of market cap weighted, how have those big companies done relative to the other 493, the Med 493?
The Med 493. Well,
yeah.
So far we've only had Tesla reported. Tesla missed earnings, right? So of the remainders, Google, Microsoft, Apple, Amazon, Nvidia, Meta, those have yet to report.
Now, is that on purpose that the bigger companies wait to the end, or is that just coincidental?
No, it's just their schedule. Let me go to.
Okay.
Got Microsoft is reporting on the 30th. Apple's reporting on the 1st. Amazon's reporting on the 1st. Nvidia is not reporting till the 28th of August. So, there's quite a bit of time left. So, those, when you look at the 7 that are beating, I mean, again, Tesla is part of the Mag 7. I think it's of the 7, it's probably the weakest version of it right now. It's the weakest participant in that 7, has the highest valuation with the lowest growth in comparison. So, I like the Mag 6, right? Google, yeah. Microsoft, Apple, Amazon, Nvidia, and Meta, and those all have yet to report, with the exception of Google. Google reported $1.89 on a $1.84 estimate, and it sold off pretty hard. Sold off about 10% so far in the last couple of days. 2 reasons. One, I think the expectations were too high, which is why it sold off on the good news. Okay. The other thing is ChatGPT launched its first, or announced that they were launching their own search called Search GPT. No different than what Microsoft did a year ago with their Bing AI search. Okay, same thing. Didn't really move the needle, but it's just kind of a knee-jerk reaction. So I fully expect Google to recoup me back in the mid 180s here within a couple weeks.
So I'm going to come right out of the gates, like second, third pitch of the game here. I'm going to go ahead and throw a curveball at you that we didn't talk about yesterday. The numbers have been a little bit better, and you just said again there a second ago that we're the companies that have reported on a median outperformed by 6%, but the market's dipped a little bit. So if the Mag 7 or Mag 6.5 or whatever, we've only had one report. To me, that sort of sounds like election results coming in with Texas, California, New York, and Texas, California, Florida, and New York yet to report, and trying to project the election. If you've left out the largest proportion or the largest contributors to that, how much does it matter what the other 493 have done when they make up a smaller part of the index? I guess, is that part of this at all, that expectations are maybe not as good for the Mag 7 and what they're going to do, or am I just completely making that up out of thin air?
Well, it's sort of what come first, the chicken or the egg, right? So the Mag 7, there's so much in those trades, and those are viewed now as market barometers, and their expectations are just insane. So here's a good example. Microsoft reported a year ago, this will be Q2 2023 earnings. It reported a year ago 269. It's going to report Q2 2024 earnings next Thursday. Okay, 294 is the estimate. It's a 9.3% increase. Okay, fine. My guess is if it's anything lower than, if those earnings have less than a 3 handle on it, Microsoft's going to sell off. Apple is going to grow by 6.3%. $1.34 share against $1.26 a year ago. Okay, they report next Friday. Amazon, 58.5% earnings growth year over year. $1.03 estimate on 65 cents from a year ago. They report on Friday as well with Apple. Okay, starting to see it. NVIDIA. Here's where everything kind of crystallizes and really makes it nice and clear. Year ago earnings were 27 cents a share. Estimate this time for on the 28th of August when they report 64 cents a share. That's 137% earnings growth alone.
Yeah.
That's a lot. Now, what's going to happen is they're going to report probably something close to 80 cents a share and then give guidance for next quarter that's far higher than it currently is. Okay. Now, that's likely. It's not for sure, but it's likely. So if NVIDIA comes in at 66 cents a share and gives estimates that leaves their multiple, it's trading at 42 times earnings. Actually, it's 36 times earnings now because it's pulled back quite a bit. 36, 37 times earnings. And it gives guidance that leaves that multiple about where it is, 36 times, 37 times, whatever. You'll see NVIDIA sell off 15, 20%. Okay. That's how high the expectations are for NVIDIA. Nobody believes the estimates. Nobody thinks those estimates are what they're supposed to be. 64 cents a share. We're looking for, probably really close to 75, 80 cents a share. And, we'll see what the earnings, what the estimates are for Q4, for Q3, but they need to increase those. And they need to increase they're going to have to increase the earnings for next year again by probably another 15, 20%. So at some point in time, this thing will normalize, right? These earnings from AI will normalize, and the expectations given will be, in line. And I think at that point we'll see a bit of a sell-off. Now, back to the chicken and the egg is, the dip in the market was because expectations in the tech sector were too high. And frankly, not the market as a whole. Don't get me wrong. Margin, we didn't have margin accounts that were spiked too high. Nothing like that. Okay. The market as a whole wasn't all that overbought. We didn't have the bulls to bears, over 2.5 times, nothing like that. I think we got to about 2.3. That was about as high as we got. So nothing crazy. But on that sector, on that group alone, it did get pretty overbought. It got pretty extended pretty fast. Not that those companies don't deserve to be at those prices, because their multiples, frankly, are very in line with their growth rates. But they moved a tremendous amount in a pretty short period of time, basically off since the April 19th lows. So, it's what happens. And when those started to sell, that got more selling from the algorithms that say, okay, I see it's bringing the S&P down below a certain level, a certain threshold of 55.75. and that begat more selling, which begat more selling, which kind of took the whole thing down. What has been really resilient through this little pullback that started last Wednesday, right, has been small caps. Small caps have done tremendously well. And, we look at small caps as a real canary in the coal mine. If you look at small caps through July, this is through yesterday, the day before. The Russell was up 9.7% for the month. The SP is only up 1.7. So we're starting to see those small caps really outperform. And what that means is, I think that's very early cycle to us, because if you look at what small caps are, that the Russell 2000 as a whole, that sector, that's 40% small and regional banks. What that's telling us is, all right, that's the equity markets pricing in policy rate cuts. Okay, because it's those smaller banks. That's what policy rate is. People don't understand. Policy rate is SOFR, Secured Overnight Financing Rate, which is what the smaller regional banks, at the rate they borrow from the larger Fed member banks, the 9 Fed member banks being Bank of New York Mellon, JP Morgan, Wells Fargo, Bank of America, Citibank, US Bank, and on it goes. Okay? All those smaller banks all over the country they borrow from the 9 Fed member banks, okay, at that SOFR, at that policy rate. So now that we're starting to see those small caps really start to move, that's the equity market saying, hey, their net interest income is going to increase. Their net interest margin is going to increase. How does that increase? The rate at which they borrow is going to come down. And the market's getting ahead of that 6 to 9 months. So we're really starting to see this small cap move. And that's very indicative of what you and I talked about, I want to say October, early cycle. Remember we said about 6 months ago, we're at the earliest part of the early cycle, or we're in that transition period between late and early cycle. Okay. And I think we've gone through that now. Now we are in actual early cycle motion. Okay. And you're going to see small caps move. We're going to see financials do pretty well. We're going to see industrials do well. We'll see materials, I think, do pretty well. I think energy consumption will be good, but I think depending on what happens with the election, I don't think energy will do well. Likely, if Trump gets in, what will happen is there'll be significantly more, or at least the perception of there'll be a lot more production, a lot more supply coming online, okay, which will bring the price down. So you're going to start to see that early big cyclical moves.
Yeah.
So you mentioned something really interesting to me yesterday on the call, that
comparing the 10s and the 2s, and that spread was down to like 8 or 9 bips now. And it was, that was the first time we've been there in a couple of years. Talk about that a little bit more, and what it has been for the last 2 years, and what that means for the economy, and now where we're kind of shifting into, what does that mean for the economy, and what does all that mean for markets?
Yeah, I'm looking at it right now on the Fed, the St. Louis Federal Report. As of close of market last night, we're at 14. We're inverted by 14 basis points. Right, I think it got to as low as 8 the other day.
Sorry, I'm fixated on your hair now. I can't take my eyes off your hair now that you've told me your gray hair.
We're at 14. We haven't been here since July of 2022. We haven't been here in 2 years. So we're starting to see the yield curve normalize, steepen, right? And this is where the 2 year, it's a shorter duration. It should pay a lower yield than obviously your 10-year, right? Because you're holding the 10-year for a longer period of time in theory. So you're taking on more purchasing power risk. Thus, the yield should be higher in theory. But how Treasury bonds work, how they're priced in the general market and secondary markets, those markets, is they're very sensitive to short-term inflation pressures. Whereas your 10-year and your longer duration bonds are a lot more correlated to general economic strength, growth, as far as that's concerned. So we've gone through an inflation cycle, not an economic cycle, but an inflation cycle, which is why we're saying we're beginning an early cycle. Inflation's is largely come down. We're starting the cycle over again. Inflation's coming down, but that looks very similar to a normal business cycle. But the meaning is different. Okay. So when the yield curve re-steepens and it becomes a positive relationship again, we're no longer have an inverted yield curve. that's usually indicative of, the beginning of a recession, right? Because, you know, the 2 year falls back through the 10 year, or it shows that the next 2 years are going to be very, very slow in comparison to out, and as far as the out years are concerned, right? So that's when we see the 2 year really start to come through the 10 year, which is what's happening now, but it's coming through at an elevated level because of inflation, not because of economic weakness. Okay, so it's different. So the economy is slowing and normalizing, but it's by no means slow. Okay, and that's the difference. Is when you look at things one compartment, saying, well, the yield curve is uninverting, which is indicative of, okay, well, the economy's slowing down now. We're probably going to go into a recession. The market's going to come down, and here we go, right? Which is what's happened a lot of the times. But this is different. This is not a business cycle or an economic cycle. This is an inflation cycle that we had to deal with. So now the economy wasn't overly hot, by the way. Okay, last year we had GDP of 3.1. Nothing outsized. We had GDP growth in 2021 of 5.8. That only followed a year of minus 2.2 in 2020. So 2022 we had a 1.9% GDP growth. So
what's the high end of that? Like, what in the last 20 years? What's the highest level of GDP growth, just as a guardrail, that we've experienced?
So, I went back 10 years. I went back to 2014, and 2018 we had 3%. Other than 2021, which was outsized, that was 5.8. But if you subtract the 2.2 from the year before, you're at 3.6. You're basically at 3.6 over the course of 2 years, which is 1.8 average between the two.
Yeah,
that's it, right? So, if you're getting like 2023 was 3.1, if you get much hotter than that, okay, yeah, you can have big problems. But we didn't have like an overheated economy. What we had was overheated prices because we had a lack of productivity, a lack of supply, and a tremendous amount of money available to people to buy things. So the demand was a little higher, but supply was really restricted. Productivity was really restricted. So now what we have is a normal economy, an economy that's normalizing, getting back into that range. Just was a Wednesday, GDP came through for Q2 at 2.8 annualized. It's perfect. It's a perfect number. It's about as good as it gets. It's not too hot. It's not too cold. It's Goldilocks.
Yeah.
It recovers from that. Remember, we had 4.9% Q3 of 2023, 3.1% for the end of the year, 3.1. So it's just normalizing.
So is it fair? Is it overly generalizing a little bit? But is it fair to kind of say that the 2 year is going to be a little bit more closely tied to inflation expectations, where the 10 year is more in line with economic expectations?
Longer term economic expectations.
So then there are two ways you can get an inverted yield curve. You can get an inverted yield curve because long term economic expectations go down very suddenly, or you can also have that come from short term inflation expectations to rise quite a bit suddenly. So I guess I'm saying that an inverted yield curve of 6% 2 years to 3% 10 years is not the same as an inverted yield curve of 2% 2 years and 0.5% 10 years. Latter is much more dangerous economically and for the markets than the former.
Correct. We're getting into a normal relationship. And honestly, they were talking about a little bit this morning on the media, and this is what a soft landing looks like.
Yeah,
and we're not through it. It's not completely doing. I guess in theory we will never be complete. It will always be some process that they're managing at the Federal Reserve. But from all the indicators that we can see, they've done a masterful job. What remains to be seen is how do they handle the policy reduction cycle. Okay, and Bill Dudley came out yesterday. He's a former Fed governor. And as recently as April, he was going on the media saying they need to raise rates even further from here because inflation clearly hasn't been whipped because of the inflation numbers we got in for January, February, and March, right? Because we had that little spike that we had in the beginning of the year, which we thought was frankly seasonal, but nonetheless. Now he has channeled his inner Keynesian and said, well, the data, and we have talked about this, the data has changed, so I've changed my mind. And he said, they need to cut now. Okay, he's saying you need to cut now. I don't think they're going to cut in July. I don't know if it would be good for them to cut in July. Well, let me just say this. I think it would be good for them to cut in July. I think they need to. Is if you look at it just through the prism of quantitate of the quant side. Yes, policy rate is too restrictive. We've seen unemployment go from 3.4 to 4.1. We have PCE at 2.5. We're not seeing any outsized moves on the inflation numbers. We're seeing owner's equivalent rent and car insurance and all of the components that has been keeping those inflation numbers just sticky. Those have absolutely just cratered in the last 2 or 3 months. So there is an absolute quantitative reason to begin cuts in July. They won't for the qualitative side of they don't want to shock markets, okay? And they don't want to communicate to markets that they got it wrong. They want to show sober, careful moves. And as we looked at it this morning, we looked on the CME, we're looking at there's a 57% chance of 3 rate cuts by December. That's what we've been talking about, right? So 2.5 to 3. So we think we'll get one in September. Now there's a case being made for a 50 basis point cut in September. I don't think that's going to happen. I don't think they need to do that, and I think that would communicate poorly to the financial markets and to the banks, saying, hey, we might have got this a little wrong. We might have stayed at the party too long with the policy rate, and we think the economy is frankly it's cooling a little too much too fast. So we're going to have to ease this up. We're going to have to put a little bit of fuel into this a little more than we thought. And I don't think they'll do that because I don't think they necessarily need to. The other thing is that could have that other implication, being that we're in an election year. If they move policy rate down by 50 basis points, the one meeting before the election could have broader implications. So that could be a problem.
And I remember you saying that you had that at maybe a 10% chance a while back, or has that the odds of that third rate increase, because you've been saying 2.5 for a while now, and obviously you can't literally have 2.5, so we're really averaging out the odds of 2 versus the odds of 3. If it's now at 57%, I think I'm not going to try to do the math there, but it puts like the actual rate cut average number at like 2.57 or something like that for the odds. So it's just the chances of that third rate cut happening seem to be on the rise recently.
It is. And of course, that's just the number today, right?
Yeah.
Here we are, July 26th.
Yeah.
But the data will be likely different by the time we get into late November. Or maybe the direction will be kind of what we think it's going to be. And that chance of that third rate cut will go from 57% to 97%.
Yeah.
Make it happen. Or there could be a bout of inflation that hits. Who knows? I mean, I don't see that happening. These things move directionally 3 years, 4 years. So the first inklings we got of inflation were way back in May of 2021. Remember when lumber prices spiked?
Mm-hmm.
Okay, all that started that commodity-based inflation really started to happen then, and then these things move directionally for quite some time, and I think now it appears to be pointing in the other direction. I think it's going to point that way for quite some time. So it's what the Fed wants to make sure of is that it doesn't point too far down too fast, right? They want this thing to kind of be gentle and just kind of live in that spot. Frankly, if 2% is their objective and their mandate on PCE, and they're 2.5 now, I don't know. I think right now at 2.5% with a 5.5% upper bound on policy rate, that's a lot of restriction. I mean, they've got a big cushion they can play with. They have a lot of arrows in their quiver, and honestly, kudos to them for doing it. Kudos to them for putting those weapons back in their arsenal and saying, hey, if things cool down, we've got somewhere to go. Here's the problem. If policy rate's sitting at 0 and the economy starts to tank, what do you do?
Yeah.
How do you stimulate it?
And we've been there. We were there for a long time where, we had really used all of our resources and we're having to invent new ones almost for, it felt like 8-10 years because you couldn't just go lower on rates anymore. It's nice to have that cushion again. Quick question. We touched on this yesterday. I'll just ask it again for the show here. Do you think it seems to me that since we talked last, I mean, it's been a political firestorm of news that we don't have to dissect all that. But do you think that the market has kind of priced in Trump winning at this point? Or do you think it's still trying to figure out? I mean, obviously there's the Biden for Harris sub out mid game is kind of an unprecedented move, and you've had a lot of other things that have gone on there, and the market's kind of the question I asked you yesterday is that, how did the markets react to all this? And you said not a whole lot. If the market's not reacting to news, it seems to me that that's kind of what it's already priced in, but I could be wrong.
Well, the market won't move all that much depending on who gets in. The sectors will have some implications. The bond market will have some implications, but not too crazy. We haven't seen all that much movement in the bond market. It's still kind of living in this 420, 415 to 425 range, kind of since the debate. Or I'm sorry, after the debate, I went to 445. But then, as PC and CPI came in, it's cooled back down. So the chances of the Trump win over the last couple of weeks, nothing has really changed. The betting averages are still, in the 58 to 60 percentile for Trump to win over Harris now.
Mm-hmm.
So, it's still looking likely that he's going to win the election, and that'll be good for small caps. That'll be good for industrials. Looks like that's going to be good for Bitcoin of all things. I mean, I guess he gave the keynote at the Bitcoin conference yesterday, talking about having a Bitcoin reserve. Which, okay, I don't know if that's just an election year thing that he's communicating trying to get the tech people on board.
Yeah,
or it might not, But the fact of the matter is it just looks like it's his to lose at this point. And so what I'm going to start doing or we're going to start doing here is after Labor Day, again, looking at the polls, looking at the direction of the polls, looking at the polls from 2020 and 2016 on these dates from those years where they were, and then building a confidence level of his election. And then we'll start building the portfolios out. There's not a lot to do. Again, we like small caps going in. I think that's part of this small cap, this early cycle move has been sort of this. It's likely that Trump might win. And although there's not huge market implication, there is nuance to it, and that could be one of the nuanced things. Is that kind of where the early cycle might have popped in a little earlier. We start to see those small cap moves. We start to see those regional banks move. There's something else to Trump winning and they were talking about this on a webinar yesterday. It's about CEO confidence, right? General confidence, and whether you like him or you don't, he brings a lot of business confidence. So there's going to be a lot. I think we'll see a lot more IPOs. People will generally feel better about borrowing money and growing their businesses. There's a lot of that. So whether it's true, it remains to be seen.
Well, and it's interesting. So we were talking yesterday, and I told you I was you used a stat or gave me a stat that I found to be really intriguing, because I was a 200-day moving average nut when I was managing money, and you mentioned that we had gotten like 13 or 14% above the 200-day moving average, which for those who may not follow trend following that much or know how that system works, for most folks who are watching the moving average as an indicator, you want to own equities when it's above the 200-day moving average. Typically when prices fall below the 200-day moving average, it can be seen as a reversal of trends and the beginning of maybe a longer term downtrend. However, and I told you I've done a lot of analysis on this several years ago. That breaks down at some point. If you run too much above the 200-day moving average, now you're talking, maybe the term would be like a mini bubble or some type of a bubble scenario where it reverses course, and where on days that the market is 1 to 10% above the 200-day moving average, it may have a very positive low volatility return, but once it gets 11, 12, 13% above, you tend to see flat or negative returns with a lot of volatility. And you mentioned we had gotten, was it 13 or 14%? Because like 15 is like the high. We don't see it get much more than 15 hardly ever, but you said it was stretched pretty tight.
Yeah, on July 16th, it got 15.06%.
Yeah. So the thing about that is
200-day. It's like we talked about. Yes, it's a spring. I think we use it's a garage door spring.
Yeah.
It just twists.
Yeah.
And the further you get away from that center axis, that 200-day moving average, not to say that if it's at 5 or 6%, it's got to snap back. I'm not saying that. But when you
Yeah.
get that far away from what you call a mean, right? And this is what is known as reversion to mean. When you get that far away from a longer term average, there is a lot of air gap there.
Yeah.
Which means everything is absolutely priced in that moment to be absolutely perfect forever. And one small thing and expectations are clearly too high. And one small development that doesn't meet the too high expectations that are already existing can cause a pullback and really cause sort of a cascading effect, which is what happened. I mean, you had Tesla miss earnings and you had Google exceed earnings, but where their YouTube segment missed top line on, by a little bit. I mean, the consensus was 8.93 billion. They posted 8.66 billion top line revenue on their YouTube segment. So that's all the reason the market needed to correct. And then when you have Tesla and Google move, what happens? The rest of the tech sector moves. Well, then what happens? The rest of the market moves. Okay. You get the NASDAQ moves. The NASDAQ went, down 7%, almost 8%. The S&P moves down almost 5%. The Dow is actually held in there pretty good because it doesn't have a lot of those exposures. So, when you see that kind of an air gap between, your 200-day moving average and your market, and I don't necessarily look at 50 days and 200 days with all that much confidence anymore. Like typically when the 50 crosses over the 200 or crosses through the 200, that's usually a good time to buy, not a good time to sell.
Yeah.
So, and a lot of that depends on a whole other factors, but it's not all that great of an indicator.
Right.
What I look at is the general trend and direction. Is that 200-day moving average pointed up? Is it rolling over, or is it pointed down? And it's pointed up. It looks great. Okay.
Yeah.
And when you have a 200-day moving average that is up and to the right at that angle, and you have a market that's 15% above that number, something at some point has to give. We know that we're a little ahead of ourselves, and we're bleeding off a lot of sentiment right now, which I think is very, very healthy. We have the bull bear relationship now at 1.36, whereas last week it was at almost 2.5. So 2.5 times the bulls against the bears on their surveys. Now we're just 1.36 bulls to bears, which is a great relationship to have. I've seen it over 3 a couple of times in the last 10 years. Once in 2015, once in very early 2018, it got to like 3.8. Which was incredible. I mean, that's just, nothing can possibly go wrong ever.
Yeah.
So it's nice to see it when it falls back under 2.
Well, and I have a lot of buddies who get into sports betting, and I imagine that you probably know some folks that engage as well. And to me, the story that you're telling, and it kind of hits on all the points, right? We started off talking about earnings. We talked about normalization levels in the economy, and now talking about the 200-day moving average, and really the overarching theme of all that. I'm just picturing, and this analogy really works better if I use live betting. Okay. So this is the time of year where you get some really lopsided games, right? You may get Alabama playing, some small county community college in Texas as a warm-up game, and the spread opens up at 56 points. And then guess what? They come out of the gates and Alabama scores 3 touchdowns in the first 5 minutes. And now that spread moves to 70 and somebody buys it. It's third quarter and Alabama's up 49-0. Yeah, but I got a 70-point spread. Okay. Well, yeah, if you're taking, when you buy that price for perfection, when it's already kind of off to a good start, sometimes that normalization you talk about is healthy. I mean, there are 2 things that can make markets go down. The data underlying the markets can go down for sure, but sometimes price just gets a little bit overstretched. And when you've not been calling, but you've been saying on the show that, we've basically been at your end of your target for a month or 2 now. So that's kind of by definition saying you're not really calling for it to go higher. Well, it's not because you're a bear. You've been talking about how much you like the economy since we started the show. The economy is really solid, but there does come a point where you might have gone a little too far too fast, and you just got to wait on it for a little bit. And that seems to be kind of where we're at right now. That price for perfection is just, it's taken Alabama minus 63. Yeah, they're probably going to win the game, but 63 is a lot. That's a lot of points.
It's funny is I would say our favorite sport on this show is to pick to pick on people in the media, right?
Yeah.
That's what we do.
I love it.
So if you've noticed, since July, everyone has moved their targets up. Now there's people at 6,000, 6,100 in a year. They might be right.
Yeah.
You know, where were they in Where were they in December? Right. They were nowhere. Okay?
Yeah.
So this is where 5350 was our year-end base case. 56 was our bull case. We're going to hold to it. You know, we'll probably come in a little bit low this year, but I still think we're going to hold to it. What's funny is there's this one pundit that gets on CNBC once in a while. I'm not going to mention any names, but he's a Bears bear. I mean, it wouldn't matter if, you know, Trump got elected and gold rained from the clouds. He's just a Bears bear.
Yeah.
And something happened Tuesday, July, I guess 15th or whatever it was. He gets on there and I couldn't believe it. He actually switched from a bearish stance to a market neutral stance.
Yeah.
And I was like, and so here in the office, we make jokes about it.
Yeah.
Okay. We make jokes about him because he's so bad. He's the worst ever. I mean, his clients have to hate him because according to him, he just sits out when the market's awesome and you're making money. And you know, so when he said that, I ran to the other side of the office and I was talking to the advisors and I said, hey guys, I know we might need to pull people out of the market now.
I was going to say, when the biggest bear gets neutral, now you're in trouble.
Because he's a neutral. If he goes bullish, we're coming out. We're coming out. Whatever he says, do the opposite. Right? It's like, I couldn't believe, like, this guy actually said something like positive because he's been saying, you know, that the Fed needs to continue raising rates. Inflation's not whipped. And, you know, like clearly he hasn't, again, back to the guy we picked on from one of the biggest banks last year. He just didn't do the work. He was calling in for $185 a share in the S&P last year. We said, no, we were in at 220. It came in at 218.
Yeah.
Okay. That's what the data had for us. This year, we think it's going to come in at 247. So we think we're going to come at 247 in a lower interest rate environment with rates coming down, solid economy, good growth, services are good. Why would we not to want to participate? Right? Finally, after the market's finally at 56.50, and he's been sitting on the sideline since probably 2,500 on the S&P. Now he wants to now we want to get market neutral.
Yeah.
Really? At 21.2 times earnings, you want to get neutral?
Yeah.
Wow.
Well, and there's a really very profound, very important lesson in that. Even though we laugh as we say that, it's not just about going against the grain or going against somebody who seems to always be wrong, but and this is true on both sides. It's very practical. When the most pessimistic person you know buys and switches sides and says, okay, now I'm going to go bull. After the most pessimistic person you know has already bought their shares, who's going to be the next buyer? Who's going to be the next one to jump onto that train? There's not. So what happens when you run out of buyers? Market goes down. And I'll tell you a real world example of this. I accidentally called a market bottom in 2011. So if you remember 2011.
Yeah, August 2011.
August 2011, the S&P downgraded the U.S. credit rating, and it caused all kinds of, the world's going to end type things. And the market sold off about 24.5% or something like that. Because I remember we came really close to 25. And I remember it was sometime around October that I was sitting in my office and I was, this close to selling. This close to selling some things. And I remembered that thought because I was a pretty optimistic bull at that point. And I remember thinking, even I'm throwing in the towel now. And right about the time that I had that thought, I remembered that. And instead, I switched course, and instead of selling, I bought. And it was literally the low point of the market that day. And it's actually, not that I'm the perfect case of that, and it was a small trade. But when the most optimistic person out there finally throws in the towel, then there's nobody left to sell. And when the biggest pessimist out there finally buys, there's nobody left to buy. And that's where you see these massive shifts in supply and demand and things reverse course. So that's an interesting topic and point to bring up there. So, well, brother, appreciate your time as always. For those of you out there, quick word from our sponsors, the Intelligent Investment Show. Well, first of all, disclosures. The Intelligent Investment Show is for entertainment and educational purposes only. Neither Matt nor I know anything about your financial situation or your portfolio, so we are not telling you what to do with it, what to buy or sell. It's not financial advice, not investment advice. If you are seeking professional financial or investment advice, you may reach Matt at his number at ARPG, which is
702-655-8300.
Thank you, dude. Always enjoy it. And we'll be back next week for a back-to-backer. And then I think we've got a funky little schedule coming up here. But by the way, if you're watching the show on YouTube, like it, subscribe to the channel, do that stuff so you'll know that every time we get our faces on here, you'll know about it. And also, I never plug that, but I should do that. Like, subscribe if you're on follow.
Yeah, you don't want to miss any of my good hair days.
That's right, because they're obviously few and far between. I mean, I am admiring
very
that,
few.
I know what you mean by
my
that.
My hairs are getting fewer. The older I get, the fewer I have.
I know what you're saying though, because I did a video not too long ago, just a solo thing I was doing, and it's like, man, my hair looks good in that one. I wish I could like just make that happen every single day. I've not been able to replicate it since.
That Aquanet, the old Aquanet hairspray, where it's like concrete, and
yes,
you go to bed and you wake up and it never changes.
But it looks soft.
Grow with that stuff on it. It's so
It looks like you've got this like nice flowing mane, but it's really like hard as a rock because you've got so much hair stuff in it. Yeah, I know what you're talking about.
Yeah, I mean, if the NFL was sponsored by Aquanet, they wouldn't need helmets.
Oh man, I love it. Well, enjoy the dude. Talk to you next week. See you, man.
Have a nice. See you. Bye.
Peace.